We're happy to have with us today Andy Larson. Andy consults with entrepreneurial farm businesses in Wisconsin to build a farm. Thanks,
Too
Andy.
many vowels in that word, I know.
Farm financial management capacity and help them access the capital they need to grow. He provides one-on-one business counseling and educational programs like the Farm Finance Bootcamp, which I'm sure he'll talk about or we can talk about at the end. But previously, Andy worked as an agricultural lender at a community bank and as a small farm extension educator in Iowa and Illinois, which we will not hold against him. Andy and his family own and operate a small scale direct market poultry enterprise just down the road from the dairy farm where he grew up. They produce free range brown eggs for local restaurants and retail stores. And with that, I will toss it over to Andy.
Hello, you guys. It's good to be with you, and thank you to the Farm Bureau for inviting me. I'm actually kind of making up an obligation that I missed. I missed the December conference, you guys, because I got COVID from the airport after Thanksgiving. Doggone it. So, for those of you that were there, I hope you had a really great one. I'm sorry I couldn't be with you, but hopefully we can make up for it here. By the way, I love for these things to be conversational, so please, please, please do not hesitate to unmute yourself and ask any questions that you might have. If you wish, I'd love it if you threw a little intro into the chat of where you're coming from, and if you've had experiences, either positive or negative, with some non-bank financing, which is what we're going to talk about today. Because I'd love to be able to really tailor this to what you guys are up to as best as I possibly can. So feel free to throw things in the chat, throw questions in the chat, or just come off mute and ask questions as we go along today. So this is what we're going to be talking about: creative farm financing, going and farming without the bank necessarily. A lot of people still don't love working with loans from banks, but there are still some needs for financing, even if that is your personal preference. So we're going to talk about probably a dozen and a half different opportunities. Some of them are going to be smaller, some of them are going to be bigger, and some of them are going to be tailored. So we'll talk about all the differences as we go along. So just by way of introduction here, let me see if I can turn on my laser pointer. There we go. I'm Andy Larson. I work for the Food Finance Institute. The Food Finance Institute is a little shop within the Institute for Business and Entrepreneurship, which is part of the University of Wisconsin system. So I am a state government university employee, non-faculty. I don't get to play in the politics. I just get to help farm entrepreneurs do what they do. We have different kinds of consultants at FFI. Our boss lady, our executive director, is Sarah Larson. She works with food systems type of businesses, food aggregation, farmers markets, nonprofit organizations. Brad Rostowski there in the middle works with food brands and consumer packaged goods companies, oftentimes ones that are trying to grow from sort of local to sort of regional. And then myself there, I am the farm dork at FFI. I love working with all different kinds of farmers, all different stripes of farmers. Many of the folks that are attracted to FFI tend to be the types that have very alternative ag type of tendencies. They're trying to be farmers and retailers and distributors and processors and restaurateurs, because we're all crazy people and we don't feel like we have enough to do. The farm that I run is growing a little bit of livestock. These are the ones that don't make me a whole hell of a lot of money, but they take up a lot of time. These are my daughters. And then these are some of the birds and my wife. We run this free range poultry farm where we raise brown eggs and sell them to restaurants and retail stores around the Rockford metropolitan area along the Wisconsin-Illinois state line. So that last slide is what a lot of people think all my farming looks like, but this is where most of my hours get spent. This is our little egg processing shed. So we've had the different kinds of financing to get into our egg business. We started with an SBA loan when we were first beginning a little over 10 years ago, a Small Business Administration. We'll talk about them. converted to traditional financing through a local community bank, where I then went to work for a number of years, have had operating capital, have had other types of capital for regular term loans. We actually secured a small grant from the Frontera Foundation to buy this little shed. And then I finished out the interior to become an egg processing facility. So this here is an egg washer. This here is an egg grater. Both this one came from Virginia. This one came from the Netherlands. So we've had some interesting experiences with different types of financing, despite the fact that it's a very, very small, side hustly types of operation for us. So this is what we're going to be talking about. This is one of the things that a couple introductory slides just to kind of set the foundation for all of this. Why even bother considering alternative financing? Well, there's a lot of people, especially when they're first getting started, who aren't bankable yet, right? They haven't got a lot of experience. They haven't got a lot of collateral to their name. They don't own a lot of stuff that the bank will collateralize. And they may not have very much in the way of a credit history, or it could be a short credit history, or it could just be a no score type of credit history because they've never had consumer debt before. I've had many farm customers that have had that happen before too. Some folks might be a little higher risk, and this could come from a low net worth situation. Again, not owning a lot of stuff and maybe coming out of school with a whole bunch of student loans and a loan on a pickup truck and just not a lot of assets to speak of. Other times I've had folks have trouble getting conventional financing because they had really unfamiliar collateral. For example, I've had an aquaponics operation as a client, and there weren't bankers that really wanted to take all these tubes and hoses and valves and troughs and all this stuff for collateral for their farm business. The other things that can kind of stick with you, a recent bankruptcy can be a problem when you're trying to get into financing. Those things usually sit on your credit report for about 7 years. Or maybe you've just got low liquidity. And liquidity basically means available cash to do stuff with, right? Your current assets are way smaller than your current liabilities. We have a whole recording about balance sheets and stuff on the Edible Alpha website if you guys want to talk about that at all. But the most frequent reason that people are considering alternative financing is because of the gap, right? Banks don't want to finance 100% of what it is you need to get your project done. If you want to buy a $100,000 tractor, there's a really good chance the bank will only get you 75 or 80,000 bucks. In certain circumstances, there are ways to get up to that 100. You can throw additional collateral on there. There's ways to do it, but those loan to value limitations become a problem, especially as you get into larger and larger projects. If you're trying to build an on-farm milk bottling plant, for example, and you need $1.5 million or $2 million, that 20% gap is substantial, right? We're talking about $200,000, $400,000. And so that's when people start looking at these alternative ways to get into financing in order to help close that gap a little bit. Now, a word of warning, and I got to get this out there right up front, just because you can use some of these sources to get into additional capital, it does not mean you should. All right. I don't want you to get in over your head. And the point of this presentation is not to help you get in over your head. Traditional financial institutions, they take a longer time in order to initiate because they are going to look at your complete credit picture. You're going to bring in a pile of paperwork. You're going to talk about your balance sheet and your P&L, and you're going to talk about your projection for the upcoming 1 to 3 years. You're going to talk about all the stuff in your credit history. They're going to bring up questions you didn't even know there was on your credit score or on your credit report. It's going to be all that stuff. And there's a reason for all of that. They want to know you and your business thoroughly, inside and out, basically. So that's it's a time-consuming thing, but it's a nice thing so that they can protect your interests and their interests at the same time. Also, just because one bank turns you down, it doesn't mean the next bank will. There's a lot of folks that I speak with who go to their, local bank that they've been using in their small town since childhood, and they get turned down for a loan and they feel crappy about it. And we're all like, okay, I'm not bankable. I'm going to have to not use this kind of financing and, completely bootstrap from here on out. Not necessarily the case. Not every bank specializes in agriculture, right? There are some banks that they just don't want to touch it with a 10-foot pole, especially the big banks. Your Fifth Thirds and your Wells Fargos, and so, those are harder to do agriculture with because they're unfamiliar with that industry or that sector. The smaller banks, the community banks, the state-run type of banks, farm credit service system, those are easier to get into agricultural credit with. So what I guess I'm saying is it's not sinful in order to interview a couple of different banks. Even if one's at your hometown bank, you can use a couple of different ones to compare rates and compare services and compare, the personality of the people that you'll be working with. All of that is perfectly fine. So you can shop around. The idea for when you're trying to get into a lender that matches you well is it would be ideal to have somebody that knows you. And that's why so many people start with their hometown bank, that existing relationship, that local reputation that comes along not only with you, but maybe your family who's banked there for generations. Oftentimes you want a bank that fits the project which you're going to be doing, which is generally agriculture, sometimes alternative forms of agriculture and retail and other kinds of food business. Make sure it fits the bank's specialty. If you start bringing in alternative type of stuff, like I'm going to be doing aquaculture, I'm going to be doing certified organic fruits and vegetables, I'm going to be raising, grass-fed emu, whatever it is, like once you start getting outside their realm of familiarity, they have a harder time knowing exactly what the math is going to look like in any given year. Also, this one right here, the lender has the time or motivation. One of the things to think about when you're first getting started, especially, is that you may not be the biggest credit that bank has, right? You may not be the VIP customer quite yet. So in that case, it's oftentimes desirable to work with a young lender, young farmer, young lender. Both of you can grow together, grow somebody who's a little bit more motivated to get customers into their book of business, as opposed to just sorting out the biggest ones that are easiest to maintain. Also, if you're trying to look for another bank outside your local small town one, check and see who they partner with. Look on their website, see if there's a page about farming and agriculture, first off. Second off, if they have existing partnerships with some outside organizations that help get financing into agriculture. The Farm Services Agency especially. Some people work with the Small Business Administration. Some even work with some economic development organizations around Wisconsin. So pay attention to those things when you're trying to choose a lender. Okay. A lot of people have on the call have probably seen this little thing before, the Sweet 16 farm financial ratios from the Center for Farm Financial Management at the University of Minnesota Extension. There are actually 21 ratios on here now. A lender is not necessarily going to work up all these different ratios for you. They're really going to pay attention to a small number of things. And here's 4 that I found to be consistently important during a credit application. Debt service coverage ratio. Do you have enough cash flow to make the payments when they're due? And that can come from amount of cash that the business is throwing off, the timing of when the cash is coming in. Do you need to have semi-annual payments rather than monthly payments? It depends on the type of agriculture that you're doing. Current ratio. Is there enough working capital for operations? This is just a fancy thing to talk about liquidity, right? Current assets. Is it greater or equal to current liabilities? Do you have the cash you need to meet your near-term obligations? Come on, advance. There we go. Debt to asset ratio. Do you own more of your stuff than the bank does? Usually once you start getting past that 50 and 60% debt to asset ratio, banks get a little bit more reticent to get you into additional credit. Whoops, and I missed the last one there. Collateral coverage ratio. If things go completely sideways, is there going to be enough assets out there at your place in order to make the bank whole, pay off the note, and sell once the collateral gets sold? Okay, so there are ways to enhance your credit picture with a traditional lender as well. And not everybody loves these, but they're perfectly good options, especially early on in your career. If you are feeling like you don't have enough credit history, you can bring in a co-signer or a co-borrower. A lot of people did that early on when they were buying their first pickup or whatever. So it's a perfectly good option when you're starting to get into your first commercial credit as well. You just got to remember that they are on the hook just as much as you are if things go sideways. Secondly, loan structure, we talked about that. Make sure that the payments are timed with the cash flow from your operation. If you're a corn and bean farmer and you get paid once a year in November when you bring stuff to the elevator, structure your loans in such a way that they get paid at that time of year. A third party guarantee is a really useful thing that can be from an individual like a cosigner, or it can be a third party guarantee from something like the Farm Services Agency. Somebody who's going to write a guarantee that says, all right, Mr. or Mrs. Banker, if things go sideways, we're going to make you whole for the outstanding balance of this loan, or a certain percentage of the outstanding balance of this loan. You can pledge additional collateral, as I mentioned, if things are not, if there's too big of a gap, like we talked about. If you want to buy a piece of ground and the bank is only going to fund 65 or 75% of what you need in order to get into that piece of ground, maybe there's another piece of ground that you got paid for, or that your folks have got paid for, that they're willing to throw on the line in order to help you get that loan amount up. Some easy things to do: pay down revolving debt. If you got credit cards, especially retail credit cards with high rates, pay those down, get rid of them. The reason being is that the entire amount on a credit card balance is technically considered current debt. So at some point, one of these card companies could theoretically call the entire amount for repayment. They don't, but it's still to skew your current liabilities on your balance sheet. And finally, fix any errors on your credit report. I've had errors on my credit report. I've had people try to open credit cards in my name. It's a pain in the butt, but do that annualcreditreport.com thing, or use NerdWallet or Credit Karma or whatever it is that is your favorite tool to make sure that your credit report looks accurate. Okay, so that was the kind of foundation laying, right? These are the reasons that people consider alternative financing. If they are going through all these steps, they've done all the things with the conventional bank and it doesn't work for them, or they don't want to work with them. Here's some of the other ways we can talk about it. Now, there's the first three slides are going to be sort of smaller opportunities. They're going to be things for folks who want to get into their first, their first goats, or their first, two-wheel tractor, or their first, trying to start out a small scale thing. After that, we'll start talking about some larger scale financing opportunities for more, conventional farm equipment or land or some of that other stuff. So I mentioned bootstrapping earlier. This is a horrible term. If you ever tried to lift yourself up by bootstraps, it doesn't make any sense in the world. It's a silly metaphor, but it's common and people know what you mean. Basically, this is using your own personal savings, using friends and family in order to fund your startup. So that was one of the types of financing that my wife and I used when we started this chicken operation. And I was building my first layer shed as a small loan from my father-in-law. So that helped a lot. And eventually, after numerous years of asking whether or not I could pay it back, it turned into a gift, which was pretty sweet of him. Personal savings, oftentimes that's limited, especially when you're early in your career. Unless you're a U-turn farmer and you were a dentist for your previous career, and you got a nice nest egg, and you can buy some ground, and you can buy some cows, and you can put up a machine shed or whatever. So oftentimes that's limited to your own accumulated wealth or the accumulated wealth of your friends and family. Now, oftentimes, mixing business and family is a thing that people don't want to do, but we in farm country do it all the freaking time, right? We think that just because we're related that we should be in business together. So maybe that's not as much of a downside for us folks that are farmers. The informal loan thing, the one bad deal with sort of the paperwork side of things is that you're not going to get an increased credit score as a result of an informal loan between friends and family. They're not reporting to any credit bureaus, I have the feeling. I'm talking a lot and everybody else is being quiet. Feel free to throw questions in here. Please, please, please. Or just come off mute and ask me questions. Second small opportunity is crowdsourcing. A lot of people have heard of Kickstarter and Indiegogo and GoFundMe and all these. There was one called Barnraiser for a while. I don't know if that still exists anymore. Not really. There's now one called Give Butter, which I thought was kind of cool for the dairy state. But there's a million of these out there. Uh, they're okay. They're legal. You're getting personal investment from folks who support the kind of thing that you want to do. You have to pitch yourself, right? This has to be the type of thing that looks really good to them. And you have to spend some time doing the marketing and communications around people even knowing that this is out there. It's not like there's a ton of folks on any given day surfing Indiegogo looking for things to throw money into, or at least I don't know that there is. And I haven't heard of a lot of farmers getting a lot of cash that way. This is usually the type of thing that people need 3 to 7,000 bucks in order for an individual thing. And that individual thing is helpful if it's something like very visible and you can post a picture like, here's the loader tractor I bought as the result of your investments. And thank you so much. And it's going to help me do this more efficiently and yada, yada, yada. So my advice on these is to use them sparingly and only use them for low dollar amounts. Don't do it frequently, maybe once or twice over the course of your career, and make sure that you use a platform that meets your needs. Um, Not only would I prefer to use a platform that has some other farmers on it, I'd like to make sure that the platform gives you the full amount that you raise, as opposed to if you don't meet a goal, then all of it goes back to the investors. So be careful about the terms and conditions that they use about how the capital actually gets dispersed. Third small one, and then we'll get into some bigger ones. Microfinance is a thing that folks in the alternative ag community have oftentimes used to get started with, a hoop building or their first herd or their first flock or their first whatever. These they tend to be smaller. If anybody's heard of Kiva, that's been relatively commonly used amongst the ag community in the upper Midwest and around the US. BRAC and Grameen are a little bit less common. But these tend to be really small loans, and they tend to be to entrepreneurs who are underbanked. Most of these things were developed for international economic development, for poverty alleviation, getting people into agricultural assets so they can start, bootstrapping their lives, so to speak. These tend to be small as well, and that emphasis on poverty alleviation isn't going to be necessarily for somebody who's past the first stage of their career development in agriculture. So those are the small sort of ground floor alternative financing, creative financing kind of things that somebody might be able to do. Now, let's start talking about some of the things that are a little bit more common in agriculture around the upper Midwest for larger order pursuits. First and foremost, I want everybody to know about this one. Most people are familiar with this one, but it's also the best win-win for most folks that are going to be on this call or any other call. The seller financing is the bomb. Like, this works really nicely. When there's a transfer of an asset between somebody in the family or somebody very close, and both members know one another, trust one another, then basically the owner of that thing acts as the bank and they receive payments from the buyer. You've seen this happen on a relatively frequent basis around the upper Midwest for, parents selling their children equipment, or parents selling their children a parcel of land, or whatever. It's becoming more common between unrelated parties as well, as folks kind of use that apprenticeship type of approach. If they weren't born into a farm family, but they want to get into agriculture, they might have somebody that they kind of work underneath for a number of years, and then with the promise that this kind of financing is going to happen at the end of however many years are agreed to. It's cool because it's flexible. The rates are usually really low. It's pretty favorable, concessionary capital, I would call it. And an interesting thing is that seller financing can actually be guaranteed by the FSA. So if you are an existing or a aspiring farm service agency customer, this can be one way to use them. It doesn't get used a lot because there's already inherent trust between parties most of the time, but As more folks who are unrelated or unfamiliar start using this as a tool, I can imagine that FSA is going to start getting more requests. Limitations. So if that trust isn't already built, sometimes it's hard to create a buyer-seller type of relationship. Ownership, like technically, formally, may not transfer until the contract is complete or otherwise refinanced by conventional lending. That varies, I think, state by state. So basically, if something goes wrong with a seller financing type of contract, technically the seller is going to get back whatever it is that you were purchasing, whatever asset you were purchasing. There's probably value in memorializing how this is going to work on paper, right? If you're going to have a loan, even with your folks, memorialize this thing on paper and say what happens if stuff goes wrong and what are the options to make things right in the case of a default. Yeah. So family transfers of land or equipment, you've all seen these things. These are the bomb. These are the place to start with if the seller has the financial wherewithal to be this financier for you. Online financing, there is a million different varieties and flavors of this right now. And there are some that are specific to agriculture. I don't know if anybody in the crowd has used Steward or not, gosteward.com. So it's everything from that's specifically designed for agriculture on up to like credit card companies. I used a Discover personal loan to buy my pickup because the rate was attractive. I already had an existing account with them. It was simple, and I paid it off early. So, despite the fact that the rate was higher, I didn't have to put any collateral down. They did not get the VIN for my truck when I was buying it. So I just liked that security of not having to pledge collateral, and that felt kind of good. And I was willing to pay a couple extra points of interest for it, but that's when interest rates were lower than they are now. So the cool thing is that you don't have a bricks and mortar location. You're usually communicating with someone via phone or chat. It's hard to build trust that way, but usually these companies are going by the numbers. They have a lot of relationships, and so many percent of them are going to be successful. So if it is a very, very specialized purpose, it might be more difficult to find an online financier that's going to do it. And the thing that I don't like about it is I don't like that I don't know the person that's going to answer on the other end of the phone if I have a problem. That's the one thing I love about calling my little rinky-dink small town bank is calling them up. They say who it is. I know who they are. And, I might have their cell phone number so I can text them even. That local relationship and that local customer service is something that I value, but it's not something that everybody needs. And as the generations go on, it sounds like it's becoming less and less important. Anybody who's bought some iron over the course of the last few years has probably had a piece of paper pushed in front of them that said, hey, we can finance this thing right here. You go to your local equipment dealer and they might have their own financial kind of service if they're part of a larger order brand. As we were talking about the dealer financing, this thing's becoming relatively common. A lot of folks have seen Ag Direct and Sheffield on the top of loan paperwork before. So that's one of those things that becomes a pretty easy opportunity for getting into non-bank financing. And oftentimes they're going to be able to do it quickly. They're going to maybe run a credit check on you to see what your score is. They're going to have pretty competitive terms most of the time. They might even be lower than what your local bank is on a piece of equipment. But because it's so quick and easy to do all of that stuff, there is a limitation, which is it's pretty easy to get in over your head. So make sure that in your overall financial picture that a monthly payment or a quarterly payment on a big tractor or a big combine or a big whatever TMR mixer, I don't know, make sure that it actually fits into your cash flow, because that's the kind of thing that a bank would do is they would make double darn sure that you can afford this thing before they were willing to extend you the credit for it. These folks are probably going to look at your credit score, see that it's 672. All right, perfect. It seems like anything 670 or above or whatever is good to go. Okay. Dealer financing. Next up. Come on. There we go. Relatedly, capital leasing is another thing a lot of OEMs and dealers have gotten into because price tags for stuff have gotten so freaking high. It's not uncommon to see combines over $1 million, right? And so there's a lot of big ticket items. Cows are expensive, equipment's expensive, pickups are everything's expensive. So as a result, some folks, in order to get around that down payment gap that a lot of folks experience, they're using capital leasing in order to get started in the ownership of an asset and then eventually graduating into standard term financing for that thing. So what I mean is if you're gonna buy one of these big old class combines brand new and you're gonna pay $1 million for it, like, okay, so the bank will lend you 800,000 if you're a good credit risk. Well, where do I come up with the other 200? I haven't got that available to me right now. It's the wrong time of year, whatever it is. You can get into a capital lease. And now this is different from an operating lease. An operating lease is a true lease, right? You've got so many months or so many years that you're going to have access to using this thing, and then you're going to give it back, and you're going to pay a certain flat amount for that use. Capital leasing is sort of a more like a rent to own kind of plan, right? So you get into this capital lease, you're paying so much per year in order to have access to this capital item. You don't have any money down, which is cool, but you have an interest rate baked into what you're paying on your capital lease that's higher than what a regular loan would be too. So you got to be aware of that there's a trade-off here. And then at the end of the leasing period, you have the option to convert a certain percentage of whatever cash you put down or cash you paid in lease payments to convert to asset ownership and then apply for traditional term financing. So in that circumstance, it's a really nice way to get into a big ticket item without that big cash on the barrelhead down payment. But you're going to be a longer period before you get into greater ownership of that asset. So just be aware of those things. All right. And by the way, the bigger financial institutions I know are getting into this in a bigger way. If any of you folks are Compeer customers, they do a lot of capital leasing, and it doesn't just have to be combines and tractors, right? It can be facilities. I've had people get into cheese making plants with a capital lease, meat processing plants with a capital lease. So things that are real assets, right? Infrastructure that's associated with real estate that can be leased as well. It takes some goofy paperwork to do it because it's pretty hard to repossess a building that's, a foundation poured on a piece of ground that you own, but it can be done. So it's worth asking about if that down payment gap is a problem. So here's a number one thing that gets brought up when folks approach me first, and honestly approach most SBDC people, most financial people. They're like, is there a grant for me to do this thing? The answer is usually no, but we in agriculture are a little bit unique. We have a unique opportunity to attract grant dollars that many other sectors do not have the opportunity for. It's not necessarily easy. It's not necessarily second nature to many of us, but they do exist. You can write a competitive application for these funds and maybe you get them and maybe you don't, but it depends on how competitive the pool is that year. So some limitations on that. Most of the time, these are not going to be for infrastructure. So that example of that little shed that I bought for turning into an egg processing facility, that was only a $12,000 shed on skids, right? So something small like that might be easy. But if you want a heated shop, right, and it's $250,000, it's probably going to be pretty difficult to get a grant for that. Most of the time, a grant is going to be for something that has some public value as well. Some research, some outreach or teaching, or for the type of working capital you need to grow your brand or grow your business. Um, but you got to watch out. You got to have your paperwork in order. They're going to ask for financials. They're going to ask for a good story, a good pitch, a good application. And many of them, more and more nowadays, are requiring matching funds or cost reimbursement or both. And what I mean by that is that if you're applying for a $100,000 grant, you got to demonstrate that you're going to throw $100,000 at this project too. And it's not just going to be the federal government or the private foundation or whoever else it is. The other thing is, most of the time, you've got to eat that expenditure first, right? You've got to buy whatever the thing is, and then you submit for cost reimbursement. So it does require some capital to get into this free capital as well. And I just want you to be aware of that. Some of the big names that are out there that you'll hear about in agricultural grants, one is the value added producer grant. I work in these a lot. We've got some folks in my shop that work in these a lot. They're specifically for folks who are growing commodities of some sort, but whether it be animals, plants, or otherwise, and then doing some kind of value adding step, whether that's processing or retailing or branding or whatever it is. There's the opportunity to get up to $250,000 in grant money from the federal government. That's the pro side. The con side is that it's a match, right? You got to have $250,000 to throw at the project as well. And it doesn't have to be in cash, it could be in kind stuff. Those are some details we can talk about at another time. It is cost reimbursable, and it is the biggest, heaviest application you've ever seen in your entire life. I've written one of these things before. It took me and another person most of a month to get one done. And in addition to the application, you got to have a business plan and a feasibility study to go with your application. Like, so it's a lot of work, you guys. But 250 grand for some farmers is potentially life-changing, business changing, right? So it is worth the effort for the right candidate to get into these grant monies. SARE grants, Sustainable Ag Research and Education. Every region in the U.S. has SARE, and SARE is usually going to be financing grants for that research and outreach type of stuff that people are doing on entrepreneurial farms. There are regional small business grants. Our grant for that little shed was through the Frontera Farmer Foundation. Have you ever heard of Rick Bayless, that fancy Mexican chef from the Mexican restaurants in Chicago, Frontera and Topolobampo? There we go. He had this Frontera Farmer Fund that was providing small amounts of unrestricted capital to small farmers, like 12,000 bucks at a time. And so that made a big difference for some equipment and infrastructure that small scale, beginner scale farmers couldn't afford. So keep your eyes out for local opportunities. I'm going to say they tend to be easier to get into than some of these big federal ones from an applying standpoint, but the dollar amounts tend to be smaller, and the pool hopefully is a little bit less competitive. No questions about grants. Anybody on here gotten grants before for anything that they've done in their farm or in their farm business? Pop it into the chat if you would. I'd love a little more back and forth here, you guys. So economic development financing exists, and it can come from a lot of different sources. There are economic development corporations in my neck of the woods. It's the Southwest Wisconsin Regional Planning Commission has some economic development funds through a revolving loan. Pretty cool, pretty concessionary, easy terms. Like it's a good thing. CDFIs, certain community development financial institutions. Many of those are purpose-driven, and there are a few out there that are designed specifically for agriculture, one being Food Shed Capital out in Virginia, I believe. And for better or for worse, these things often come with technical assistance, which means you are going to be meeting with a a muckety muck like myself on a regular basis to see how everything is going in your farm business from a financial standpoint. Many of these things are location specific. You might have it through a county, you might have it through a region, you might have it through a utility company that covers a specific area. They might be specific to purpose. And additionally, rates can be pretty high. But all the rates are high right now. So before, when everything was super duper low a couple of years ago, some of these economic development funds seemed pretty uncompetitive from a rate standpoint. But now, when everything's in the eights, it doesn't look like quite as big a differential. WIDA and WIBIC are both linked here at the bottom of the slide. Sometimes you see a revolving loan funds from other outfits. This is one for the Southwest Wisconsin Regional Planning Commission, Regional Revolving Loan Fund. Low interest money on average 4% sounds pretty freaking good right now, doesn't it? And they have their loan documents right there too. So I don't know where y'all are from, but like look in your area for revolving loan funds, and start general, Southeastern Wisconsin, Northwest Wisconsin revolving loan fund when you're doing your Googling around, and see if you can find something that matches up. Okay, I'm trying to advance. There we go. This is going to become a growing thing, I think, in our agricultural community and our agricultural economy. Is we're going to see more opportunities to get paid for conservation and ecosystem services. We already have some opportunities out there right now. The NRCS has all these neat cost share programs, which we'll talk about in just a second. But you're going to see more options, I think, as we continue to move forward. So folks who are doing rotational grazing, folks who are doing cover cropping or long crop rotations, folks who are doing solar energy, folks who are doing all these different things are going to start seeing these different kinds of opportunities. So it could come in a lot of different forms. Sometimes it's a direct payment, sometimes it's a rent, sometimes it's a cost share, sometimes it's a tax rebate. But they're all trying to encourage some kind of ecological good. In Wisconsin, which is a livestock heavy state, it's oftentimes about keeping phosphorus out of surface waters, right? So things like, riparian buffer strips and those kind of deals are going to have some encouragement from different places in order to get put in place so farmers can, have a way to offset the cost of installing them. This is going to have a couple limitations to it. It's usually going to be an established farm. So if you're brand new and you don't have like a farming history, it might be a little bit harder to say, oh yeah, we're going to be around for 20 years and we want this, long-term payment on whatever it is, solar panels, etc. Also, when you're working with the NRCS specifically, you're almost always going to be dealing with some kind of scoring rubric, right? There's going to be things that need characteristics of your farm that score you higher or lower, characteristics of the practices you're using that are scoring you higher or lower. So you want to have some familiarity with how those scoring rubrics work. And I would highly encourage you, if you don't already have this relationship, make friends with somebody at your county NRCS office who can be your concierge, right, to all of these programs that they have available. Because unfortunately, it's just like every other USDA or federal website. They're hard to navigate. They're super dense. You occasionally can't get to the right place that you want to get to. And the rules change almost on an annual basis. So it's really, really useful to have somebody at the NRCS office, a district conservationist or a soil con or whatever, who knows these programs, or even if you are, certain practices that the NRCS really pushes, like if you're a rotational grazer, you want to know the state rotational grazing guy so that he knows what practices you got going on your farm. And there's some regional grazing people as well. Um, so most of you have seen the alphabet soup that comes from NRCS, right? You've seen EQIP, Environmental Quality Incentives Program. It's all linked here. Conservation Reserve, that's the old set aside program. CSP, Conservation Stewardship Program. So that's going to be pretty common ones that people are familiar with. But what we're also starting to see, and is a little bit Wild Westy still is some of these nutrient credits, like carbon credits. Like, have they existed? Have those markets existed? Yes. Have they lasted for a long time? Not necessarily. Indigo Ag is probably one of the leaders that's really trying to figure out the carbon credit thing. They're oftentimes looking for ecosystem services on a pretty broad swath of land, so the small farmers aren't going to get as much benefit as somebody who's larger and broad acre. Um, Nonetheless, there are some other interesting things going on as well. Solar grazing, you can stack conservation benefits. And so, like, if you got a piece of ground that's getting eyeballed for solar panels, and you can get a 30-year rental contract from the utility company at 1,000 or 1,200 bucks an acre, those numbers are not, they're not false, right? I'm not just pulling those out of the air. Those actually happen. And you can get some credit for having, perennials below those ecos or below those solar panels, or you can have grazing. You can really start stacking some of the financial benefits on one piece of ground, and it really starts being able to help finance some of the other parts of your operation that may not, have quite as much cash coming in from outside sources. There is government financing. If you're not familiar with the FSA, the Farm Services Agency, they're a wonderful place to get into your first ag loans. They're not the easiest place to stay with for your entire agricultural career because part of their mandate is to graduate you to conventional financing once you're eligible. But they do have favorable rates. Yes, they have gone up in the last couple of years, just like everyone else's has. They track a certain benchmark. Um, Also, it is sometimes easier to use the FSA in collusion with a traditional bank. So, like, if you're going to do joint financing, it's really wonderful to have the FSA cover 50% and the conventional bank cover 50%. Or if you're a beginning farmer, there's a 5-45-50 where you put down 5%, the bank puts down 45, and the FSA puts down 50. Or no, I got that backwards. The bank puts down 50 and the FSA puts down 45. They have some really nice favorable rates, like in the ones for things like that. So really very attractive, but you need to have 3 years of production experience under your belt. You need, or production or management experience under your belt. It's easier when you got 3 years of Schedule F. So it's not necessarily going to be the very first thing you do when you start farming. By the way, the Small Business Administration, the SBA, that is a thing that farmers can use. It's not as common. I used it to guarantee a small loan early on, but it's totally available. You just generally need to have somebody who understands the paperwork. There is more and more of these unbanks out there nowadays. If anybody has ever gone to the Regenerative Food Systems Investment Forum website, there is a lot of capital out there for what people are calling regenerative ag. And I don't know a better term than what to call these things other than unbanks. They're not banks, but they are financing. They are loans that are coming through, these recently created organizations. They're more mission driven. Some of them specialize in leasing. Some of them are specializing in more traditional lending. Most of them are going towards small, sustainable, regenerative, or alternative type of agriculture. It is going to be a higher touch relationship, but along with that higher touch comes with a lot of flexibility. I've seen a lot of people get, terms extended, get payments delayed, things like that if something goes wrong because they're doing something experimental. Many of them are limited to organic certification right now. I think that's going to become less and less as we go along. The proportion who require organic certification is going to go down because there's other types of certifications out there now, but that's just kind of the way that they're differentiating. It's an easy line in the sand to draw. They are relatively young organizations, only been around for 10 years, 5 years, 2 years, whatever. So we don't know the, total business life that these things are going to have. And most of them have a limited pool of capital based on what they can raise through private equity, right? So many of them are making loans and they've got 5 million bucks to lend that year, and once it's gone, it's gone. and you have to wait for the next, surge of capital to come into their organization. So it's not quite as straightforward or regular as using a traditional bank, but they can be really very well values aligned. They can be really flexible, and it can be a very, very useful relationship. Two more slides, and then we're going to stop and ask for questions, you guys. Patient capital is an opportunity. So some people are interested in getting investors in their farm or their farm business. And it's not common in the agricultural world because most investors, okay, with one exception, outside investors buying farmland and expecting a return on that. We've all seen that in Iowa and central Illinois, and maybe even a little bit in Wisconsin too. Um, these are not quite the same kind of thing. Um, they're impact investors, I would say, is the normal financial term for them. They're trying to get some kind of broader order societal benefit created by investing in some kind of alternative agriculture, right? It's not slow money is the one big example that's out there, and they're still self-organized around specific groups or specific cities that are interested in specific things. So sometimes we have one that fits great. We've got a chapter in Madison that's been around for a long time and invested in agriculture. Got one in Chicago, but it's not necessarily going to be for everybody who's way, way, way outside those metropolitan areas. The thing that's funny about equity investors, and that could be slow money or that could be somebody else, is that there's not a real common template that you can lay over this business relationship, this financing relationship. Every investor wants something just a little bit different. Your traditional investor in Silicon Valley or whatever wants to get into a brand new company that's never, been around for very long and wants to get on the front end of like this logarithmic growth curve, right? And just see their money grow by leaps and bounds in the first few years, have a big chunk of this thing, and then force them to sell for $1 billion or have an IPO or whatever. Farming's a little bit different. We don't usually have those kind of logarithmic growth experiences that, that your Silicon Valley types might occasionally have. We're oftentimes living on the places that we're financing. So there's a lot tied in between personal and business, whether we like it or not. And, some of these investors are going to be like, they're in it for the good, they're in it for the impact, and they don't require a whole lot of return or ownership or say. And some are going to be like, no, I want to be active in this. I want to make sure your business grows, and I'm going to give you advice and expect you to follow it over the course of your business. So there's different ways that these things work, and you got to be sensitive to how they want to be involved in your business going forward. And of course, make sure you have an attorney, memorialize all of this stuff, make sure that we know what happens in the what if scenarios, all that stuff. So that's a lot of different types of non-bank financing that a farmer can get themselves into. And as I mentioned on the upfront, be cautious. Just because you can doesn't mean you should. Know very well what you can afford from a cash flow standpoint in your farm business operation and what you can't before you start considering some of these things. Don't get in over your head. No surefire way to get into trouble than to have too much debt burden especially for a small or beginning farmer type of business. That's what I had prepared, and I'd be curious to hear reactions to this. If we got questions out there in the crowd. Wendy, I'm glad to see you back. We lost you for a hot minute there. I hope the
Yeah,
recording's okay.
my computer just turned off, so I was not sure what was going on. So I'm back.
Convenient.
Yeah, very convenient. Uh, Happy New Year to me. We'd love to take a few questions. If anybody has any for Andy today, you can go ahead and either put them in the chat or you can raise your hand. I don't see anybody with their hand raised.
Or if anybody just wants to give like kudos or thumbs up to any of these options that I threw out there, anything that would be sort of a positive experience or a negative experience with any of those options.
That would be great.
And if you don't start, participating, me and Wendy are both going to start singing. Okay.
That's my jam, Andy. So I love a good karaoke session.
Karaoke webinar.
I don't want to just volunteer someone to give an answer or ask a question either, but I
If you
could.
know him well enough.
I mean, Isaac, Sarah, can you help a girl out and ask a question here? No, they won't. Okay.
And if we're done, we're done. That's fine too.
All right. Well, thank you.
Oh, Isaac, that's a great question. So FSA, the Farm Services Agency, and I hope I said all the acronyms as we went along. The Farm Services Agency has different tiers of lenders that they partner with. There's the folks who have never used them before who are in their initial tier. There are those that are in their middle tier, which are like, it's easier for it's a streamlined paperwork process, and the bank has more say as to approval or non-approval. And then there's the top tier, which is like the bank does whatever it wants, sends in the paperwork to FSA, and they rubber stamp it. Right? So it's just basically the depth of trust and relationship that that bank has had with the FSA over the years. So you can kind of progress up those different levels as you make more and more loans. And more loans that work out in the positive as well.
Excellent.
Cassie's got a question. What are the pros and cons of farmers pursuing an SBA versus FSA financing? There are some differences. The main pro for SBA is that they cannot turn you down for lack of collateral. They will look for equity anywhere, including any ownership position that you have in your home, your personal house. So they're not going to be, suckers and say, oh, you don't have to put any more collateral down. They will get the collateral where it's available. But for those folks who genuinely do not have it, they cannot turn you down solely by virtue of a lack of collateral. So that's the big pro. The cons are that there are fewer people in the agricultural community that are familiar with it and know how to do the paperwork. Their interest rates tend to be a little bit higher, and the proportions that they will pay off for the bank if things go into default are a little bit lower, like 75% rather than like a 90%. The FSA is specifically designed for agriculture. And so they're very familiar with the types of things that farmers do. Their loan officers and loan managers tend to be extremely well versed in agriculture and even open to ideas around alternative agriculture, where some of those business models might be a little bit less familiar to the SBA. So there are considerable differences. The SBA traditionally is used for non-farm startups. Very, very common to be used in non-farm startups. If you've ever heard the terms SBA 7A or 504, those very odd names, but they're two different programs that the SBA has, and you can use them to buy businesses. They have nice long financing terms, more than most commercial credit it usually has. So like 20 to 25 years, where a lot of commercial credit can be shorter than that for non-farm entrepreneurs. But FSA is usually the thing that farms default to first. I had an SBA loan because I was brand new. I didn't have any collateral, and the lady I was working with was an SBA lender, so she just knew that program well.
All right, excellent. Thank you, Isaac. Thank you, Cassie. I think we are going to wrap up here. We have some exciting news. We just entered a partnership with the Food Finance Institute, and we'll be offering a member benefit for discounts on the programs offered from the Food Finance Institute. Some more information about that will be coming out soon. So check your rural route, check our social pages, and see how you can be a part of that for more learning opportunities for your farm and business.
And if anybody's looking to be a very consistent student of their farm finances this year, just a little plug for you, if you don't mind, Wendy.
For sure.
There's a couple of cohorts that we're starting. One is a beginning farmer cohort. And so it's going to be a meet monthly kind of thing with a group of farmers, specifically talking about a certain realm of farm finance, we'll talk about business models, we'll talk about market research, we'll talk about accounting systems, we'll talk about all those things that we need to eventually get into the capital we need to grow our business. So if anybody is a beginning farmer, there's one cohort. If anybody's a more experienced farmer and specifically looking to do some value-added ag type of stuff, we'll take those as well. And they are going to be grant supported, so no cost to you. If
Oh,
anybody's interested,
excellent.
please follow up with me.
Yeah, excellent. Thanks for sharing that, Andy. Our next Lunch and Learn will be the first Wednesday in February, and we will be highlighting Gather, Wisconsin. So please mark that on your calendar and watch for more information coming soon. Wishing you all a happy new year. Like you saw, this is recorded, so if you'd like to go back and watch the recording, we will have that available soon. Have a great day.
Look at you being prompt.